Good morning, venture capital. This is Metagame, and today's episode is about how Boston's quantum revolution is bending the rules of the investment game as East Coast money flows into a new frontier that's leaving San Francisco scrambling to catch up. Everything you think you know about San Francisco's dominance in venture capital? It's not just wrong, it's mathematically embarrassing. And by the time I'm done here, you're going to look at your portfolio allocation and wonder why you've been operating in the wrong arena for the last 3 years. Here's the number that should make every West Coast-focused investor deeply uncomfortable. Boston just deployed $137.8 billion in venture capital last quarter. San Francisco, $57.3 billion. That's not a gap. That's a 2.4x capital advantage for a city that most VCs still treat like a regional afterthought. Boston isn't playing second fiddle to the Bay Area anymore. Boston is conducting the entire orchestra, while San Francisco argues about who gets to play the triangle. But wait, it gets worse for the Sand Hill Road faithful. Boston's deal count surged 44.5% quarter over quarter, from 128 deals to 185. San Francisco, 22.9% growth. Still growth, sure, still respectable. But when you're growing at half the rate while deploying less than half the capital, that's not competition. That's a controlled decline dressed up in a nice press release. Let me put this in terms that actually matter for your returns. Boston's average deal size last quarter was $744 million. San Francisco's? $356 million. Boston deals are more than twice the size. These aren't scrappy seed rounds getting funded at some Cambridge incubator. These are massive growth rounds, late-stage infrastructure plays, and the kind of checks that move the needle on a fund's performance. The mega rounds that everyone assumes are happening on the West Coast. They're happening 3,000 miles east. Now zoom out, because the Boston story is just one chapter in a much bigger narrative that should concern anyone over-indexed on California. East Coast total, 2,181 deals, $1.06 trillion deployed. West Coast, 711 deals, $180 billion. That's a 5.9x capital ratio favoring the East, not 2x, not 3x. Nearly 6 times more capital flowing into East Coast deals than West Coast. Building a new product? Temez Labs takes you from napkin sketch to the App Store. Trusted by Fortune 500s for quality, security, and speed. Book your free strategy session at temez.ai. The deal count ratio is 3.1x. The capital ratio is 5.9x. What does that gap tell you? East Coast deals are substantially larger on average, $486 million versus $253 million. The growth rounds, the scale rounds, the rounds that actually generate returns for LPs, they're happening in Boston, New York, and increasingly in places like DC and the Research Triangle. Meanwhile, the West Coast is still funding consumer apps that'll be gone in 18 months and developer tools that'll get acquired for parts. This geographic shift isn't random, it's structural, and it's directly tied to where AI capital is actually deploying. The global AI market saw $202 billion in investment last quarter. And here's what most people miss, that money isn't just flowing to companies building foundation models, it's flowing to companies deploying AI into the world's largest industries: healthcare, financial services, government, enterprise infrastructure. And where are those industries headquartered? Not Palo Alto. Boston's surge is inseparable from its dominance in healthcare AI and enterprise infrastructure. You've got Massachusetts General Hospital, Harvard Medical School, and MIT creating a biotech AI nexus that no West Coast ecosystem can replicate. When enterprises are deploying AI agents with average budgets of $124 million, and 26% of them have already pulled the trigger, Boston's companies are perfectly positioned to capture those contracts. This isn't speculative AI research. This is mission-critical deployment with long sales cycles, high switching costs, and contract values that make consumer AI look like a hobby project. San Francisco's $57 billion probably captures more foundation model companies, more consumer AI plays, more developer tooling. And that's fine, except foundation models are commoditizing faster than anyone predicted, while vertical AI applications in healthcare and finance are capturing actual revenue. Boston's ecosystem is structurally advantaged for the deployment phase of AI. San Francisco is still optimized for the research phase. Guess which phase generates returns? The East Coast's 5.9x capital advantage is being driven by AI's expansion into traditional industries. Financial services AI is concentrated in New York. Government AI is concentrated in DC. Healthcare AI is concentrated in Boston. These are massive total addressable markets where East Coast proximity to customers, regulators, and talent creates advantages that no amount of West Coast engineering culture can overcome. The $202 billion AI boom isn't just flowing to the companies building models. It's flowing to companies that actually sell to the Fortune 500. And the Fortune 500 doesn't take meetings in a WeWork in the Mission District.
Oh, hey, friend. Do you like what you're hearing? Now you can have a ridiculously amazing podcast, too. Check out holler.studio to get yourself one today.
So what does this mean for your strategy? First, look at your geographic exposure. If you're seeing 10 San Francisco deals for every one Boston deal in your pipeline, but the market is deploying 2.4x more capital into Boston, your sourcing network is fundamentally misaligned with reality. You're not just missing deals, you're systematically filtering out the opportunities with the highest capital velocity. Second, think about valuation discipline. When 5.9x more capital concentrates on the East Coast, West Coast deals may be experiencing relative valuation inflation. Too much money chasing too few quality deals, while East Coast deals maintain discipline due to ecosystem depth. You might be paying a premium for the privilege of being in the wrong geography. Third, consider the talent implications. Capital attracts talent. If Boston is capturing $137.8 billion versus San Francisco's $57.3 billion, top operators and engineers will increasingly choose Boston opportunities, especially in AI healthcare and enterprise infrastructure. Brain drain from west to east isn't a hypothetical anymore. It's a trend with a $100 billion tailwind. The strategic play here isn't complicated. Stop thinking AI is in San Francisco, healthcare AI is in Boston, financial AI is in New York, government AI is in DC. Match your sector thesis to geographic reality, and you'll find better valuations, faster paths to revenue, and companies that actually have customers instead of just GitHub stars. Cross-geography arbitrage is real. Source early stage in San Francisco, where the research talent still concentrates, then support scale-up in Boston or New York, where the enterprise customers live. Companies that can prototype in California, but close contracts in Massachusetts have structural advantages that pure-play Bay Area startups cannot match. If you're building a portfolio today, the 5.9x East Coast advantage suggests at least 60% of your new capital should flow east. Not because San Francisco's finished. It's not, it's still growing. But growing at half the rate while deploying less than half the capital isn't winning, it's managed decline. The narrative that San Francisco owns venture capital isn't just outdated. It's mathematically over. The data is clear. The capital flows are clear. The deal velocity is clear. Boston surged 44.5%. San Francisco grew 22.9%. East Coast deployed $1.06 trillion. West Coast deployed $180 billion. Average East Coast deal, $486 million. Average West Coast deal, $253 million. So let me bring this back to where we started. Everything you thought you knew about San Francisco's dominance, the numbers say you've been operating on a narrative from 2015 while the market moved to 2026. The question isn't whether the East Coast is winning. The data already answered that. The question is whether your portfolio is positioned for where capital is actually flowing, or whether you're still betting on a story that the market stopped believing 3 years ago. The arena shifted. The capital shifted. The mega rounds shifted. The only question left is whether you're going to shift with them or keep working for scraps in a market that's already moved on. That's our Venture Capital podcast for today. If you learned something new, tap 5 stars and follow our show. Thank you for listening to Metagame.
Grep News. Thomas.